The focus of this webinar is SaaS groups, and the subject is your SaaS group structurally fit for investors and buyers. So we're going to be talking about the role of corporate structures and intercompany agreements for SaaS groups, not just for tax compliance, but also the role and significance in terms of preparing for exit or significant investment for the company. My name is Paul Sutton, but I'd like to introduce our star guest today, who is Anthony Nitsos. Anthony, perhaps you can just briefly explain your background.
Well, I'm not so sure I'm a star in anything. Maybe my kids think so when they're not trying to pull me down to the earth, but thanks for the intro. SaaS Gurus, we specialize only in SaaS companies, startups in particular, throughout the world, the United States primarily, but also in the UK and in EMEA. I've had personally 2 exits of a unicorn status as a SaaS company. I've been working with SaaS companies since about 2007. Numerous startups, raised over $350 million from my clients in that time for various venture reasons. And pretty much that is what we do. We specialize only in SaaS companies.
Fabulous. And just to introduce myself briefly, so my name is Paul Sutton. I'm a corporate lawyer by background. I've been qualified for about 30 years now. I'm the co-founder of LCN, and our specialism is that we look after multinational groups and we help them make sure that their legal structures and their intercompany agreements are fit for purpose. So we work alongside transfer pricing and international tax professionals, both in-house teams and teams in advisory firms, to help take a holistic and global perspective to corporate structuring and legal structures. So what we're aiming to cover today is, firstly, just reconfirm what we are talking about. So what does it mean when we're talking about corporate structuring? Anthony will go through a case study which I think really illustrates why corporate structure matters. In other words, what went wrong in that particular case and what it took to fix that. We're going to move on and talk about what do investors and buyers actually look for as regards corporate structuring and hygiene. And we're going to move on and go through what are the different cross-functional benefits of having a clearly documented corporate structure, including intercompany transactions. And then finally, we're just going to go through some basic actions for founders, CFOs, and general counsel who are looking after their groups, and they want to make sure that they are fit for purpose and due diligence ready. So just a bit of housekeeping. We will have time for Q&A later, so towards the end, please do use the Q&A function of this webinar, and we'll do our best to pick up questions as they arise. We will circulate the slides after the event, and in due course, we'll circulate a recording to those of you who couldn't make it. So first of all, what are we talking about when we talk about corporate structure? So it includes what legal entities do you have in your group. It includes what permanent establishments or branches you have as well. It includes the people in your business and how they or where they are located and which legal entities they are engaged by. It also includes the contracting model of the group. In other words, which entities actually sign contracts with the outside world, whether inbound or outbound contracts. It includes your IP and other assets and where they are actually held, in other words, in which entities. It also includes the funding structure of the group. And so when we're talking about the corporate structure, we mean the legal entities involved, the relationship between those entities, including intercompany transactions, and it includes the key assets and people and how they relate to those legal entities. So just to give a very brief example of that, on the right-hand side, this is a real-life example. So in this case, it was a US-based SaaS company, so Entity A. At the outset, everything in relation to that group, functionally speaking, was based in the US. So management, the product's IP was held in the US. All sales were made by the US entity, even international sales, customer contracts, and R&D. And what happened is that it acquired in 2023, it acquired a group in Germany. So this is Entity B. And the rationale for that acquisition was that the Entity B technology was considered to be synergistic. In other words, it would have value when combined to the Entity A portfolio. So when you're talking about, well, what does the corporate structure, what does the group structure look like post-acquisition? It means going through a series of questions saying, what impact does this acquisition have on the contracting model? Are you still going to be making sales out of entity B? What are we going to do with the entity B IP? Is that leaving that in Germany? Is it extracting it to the US? Is it some structure which leaves some value in Germany, but the ongoing value elsewhere? So we're talking about the overall corporate architecture of a group and how that maps onto the countries and legal entities. So hopefully that helps frame what we're talking about. And I'd like to hand over to Anthony to talk us through a particular case scenario that he came across.
Thank you, Paul. So this is a live case example, anonymized, of course. This was a client that our firm engaged with a couple of years ago when we first started with them, a SaaS company. What they had done is they had created a SaaS solution that was actually initially intended for internal use to support their customer success department with their clients on a service type of industry. But the software that they developed turned out to be quite useful, and found out that certain clients actually would be willing to pay for just the software and use it themselves. This was a Canadian company. So they spun off a US corporation because the founder wanted to have a US based corporation because access to the venture capital markets would be easier. Also felt that there was obviously a much clearer and larger market, total addressable market for them in the United States to start with. The economy, of course, being much larger than the Canadian economy. So for various reasons, spun off a US corporation. So you can see from the org chart, you have the owner founder, 100% owner of the Canadian corporation. This was where your original marketing and sales and G&A occurred. Spun off the US corporation, we'll say, effectively 2023, which was where they were going to start doing the full scale sales and marketing, and also some additional G&A support there. That's actually when I and my team came in to help them with the finance side of things because they needed help on the south of the border, as it were. In the background, there's an Indian corporation, which was also 100% owned by the founder, who is from India. And that corporation had been a long time, was the corporation that developed the software that we're talking about. The payments, for the most part, were coming from the Canadian entity to the India entity to support that operation. And then, of course, once the US corporation was spun off and moved to the south of the border, as it were, the US corporation, once it started getting enough traction, it then became the source of the payments back to the Indian corporation. So you see there the dev dollars pre-1124, I just picked an arbitrary date, and then around January of 2024, the dev dollars start coming from the US corporation into India. So what's the problem here? Let's go ahead and go to the next slide. So the case, a commonly owned Canadian company pays its India software company for software development, spins off a US subsidiary to commercialize it. First gap, none of the employment contracts had work product assignment. If you're not familiar with that term, basically in any employment or vendor agreement for anybody who's doing software development for you, anything that touches your code, anybody who touches your code, any entity that touches your code, you need a contract that very explicitly states that they have no claim to that code, that it's work for hire, that the company owns and retains 100% of all rights from now forever into the future. That's called the work product assignment clause. And you find this fairly standard in all employment agreements for any company that's, basically developing software. The problem here is that none of the employment agreements, neither in India nor Canada nor the United States, had any such clause. And so on a due diligence, when an investor or an acquirer were to come in and say, hey, I want to see your employment contracts, it's a very standard request. If they don't see that work product assignment, that's going to immediately raise questions in their mind as to, is there somebody out there or some entity out there that could lay claim to the IP for this particular software? So that's the first gap, and it's a pretty big one. The second gap is there was never really a formal transfer of the IP from the Canadian entity into the US. So if the Canadian entity, if you go back to the org chart for a second, Paul, go back to the prior slide.
Yep.
The Canadian entity is paying the India entity for software development. That's what's keeping the India entity's lights on and their employees paid, is the cash coming from the Canadian corporation. There was then the movement of the operations into the United States where they started commercializing it. And there was never a formal transfer of the IP across the border from the Canadian entity to the US entity, nor were there any payments being made by the US entity back to the Canadian entity for use of the software. There simply wasn't anything documented or formal. So go back to the next slide. That's another fairly substantial gap in that there was nothing really documented on, okay, actually has the rights to use the software and who's being paid for the development, et cetera, et cetera. And then the third gap is that there was never a transfer pricing analysis done for the US and Canadian corporations. So if you are, the Canadian company is still performing services for the US company and things are kind of getting mixed and muddled together, there's, again, not a clear, movement of money or profits or costs or anything across the border, then it leaves you really open to potential tax liabilities and claims on both sides of the border, either in Canada or in the United States. So we had kind of three gaps that we really needed to deal with here. So the first thing is the employment contracts need to be redone. Okay, absolutely, we need to make sure that employment contracts, and I should also say vendor agreements, but it was primarily employment contractors, also need to be done. The good thing is that for the most part, all of the development was done in India, and changing employment contracts there was actually a fairly straightforward thing to do. If you change an existing employment contract in Canada or the United States, you actually have to offer a consideration to that employee in return for signing that agreement. Otherwise, it's not binding. So fortunately, we were able to come up with a way to do that where it didn't cost the company that much. And also the fact that the development had all happened in India, none of it really had happened in the United States. And none of it was directed from the United States or Canada other than by the owner himself. It made that a little bit straightforward to do. But again, it's an administrative process. It takes time. Employees are going to ask questions. It's not a good situation overall. And it should have been addressed in the employment agreements in the first place. Rule number one is always have your work assignment in your employment agreements from day one. You should never skip that. The second thing was, the retroactive transfers cannot be done, right? We can't go back and say, hey, we transferred this IP from Canada to the United States back in January and it was only worth X amount of dollars. No, you can't do that. If you're going to do a transfer of IP, you pretty much have to do it today. And every day that goes by where there's more commercial activity associated with that, the more valuable that IP becomes, and therefore more of a taxable event that any potential transfers of that IP across the border could result in. So if you are going to transfer the IP across the border, you want to do it as soon as you can. You want to do it as early as possible in the process where the valuation is as low as you can possibly make it so that you don't have a large tax bill that results from it if you're going to do a transfer. It doesn't mean you have to do a transfer. There are other ways to do that. So what about doing, in this case here, an exclusive licensing agreement, which says that the US entity has an exclusive 100%, the only entity that can do it, licensing agreement between the companies. That in the end is what we decided to do because we couldn't go back and do a retro transfer, and the valuation was now quite substantial because X years had gone by in taking care of the situation. So in the end, the solve number 3, there was an exclusive licensing agreement between the companies had to be created. There are tax implications involved there, but there wasn't a wholesale transfer of the IP across the border and, a big tax bill that would result from that. So not ideal, because in the end, this US entity is one that's going to be receiving investment capital. And investors in the United States, I think investors anywhere like things simple. They don't like things complicated. Complicated IP structures and licensing agreements tend to put them off. What's to the benefit here is that everything is owned by a single person. He owns the Canadian company, owns the Indian company, owns the US company. It's all fairly clear that this is all a single person. It's not having to deal with another third party and an agreement that could possibly go awry. So, but again, it's not as clean as it could be. And then the transfer pricing analysis really needs to be done. Fortunately, the India entities bills, if you will, back to the Canadian entity were done under an India transfer pricing regime that was actually part of their regulations and their laws. So it was, kind of a check the box kind of thing. They had to have a certain markup on their bills back to the Canadian entity, and in doing so had satisfied the India authorities. So we didn't have an issue there. But we did have an issue between the Canadian and US entities because no transfer pricing agreement or analysis had been done. Now, in this case here, we did one. And with all transfer pricing analyses where you have complicated structures where you've got some sales and marketing occurring in one country and some sales and marketing occurring in another country and development in a third country and G&A across the border, that kind of a transfer pricing analysis tends to be expensive and complicated because the transfer pricing people have a lot of questions and they're going to want to make sure that they're covering all their bases. And of course, you're dealing with cross-border stuff, so that automatically doubles the price of anything related to tax. Paul's laughing because he knows exactly, if not tripling it, because they know they can charge those rates because it's a specialty type of case. Fortunately, there are plenty of people who do both Canadian and US. It's been an economic relationship for decades, centuries, if you will. So it's a fairly well-established cross-border type of arrangement, but still, of course, you're going to pay that premium. So it wasn't easy to solve this one. And if we get to the next slide, really the takeaways here are: one, don't ever miss your IP work assignments. Just don't do it. Make sure your employment agreements have it. It's an easy thing, right? But, it's funny if you don't know what you don't know. And in this case here, the founder didn't know what he didn't know. It can cause you to create a misstep. And the other thing is, if you are going to spin off a subsidiary from one country to another, you should have your tax, legal, and IP experts in the room on the discussion from the get-go. Before you make any moves, really, you should be talking with the experts that know about these things, because they can help you avoid expensive tax pitfalls. If you're going to be taking in venture capital or you're going to be acquired, they can help you prepare for the inevitable due diligence that is going to occur when somebody comes in. And so the old saying of an ounce of prevention is worth a pound of cure. A gram of prevention is worth probably a whole kilogram or a ton of cure in this case, because these kind of fixes can be very expensive. And in this case here, fortunately, it wasn't terribly expensive, but the legal fees in the end were substantial. The tax fees in the end were substantial in order to go back and fix this. And probably 90% of that could have been avoided. I'm not exaggerating. 90% of that cost could have been avoided if the proper experts had been in the room in the first place and helped them structure this properly.
Right. And Anthony, just to your point, the timing is critical. So obviously the value of a business changes over time, and you can't rewrite history. You can't backdate an IP assignment or anything like that. And therefore, it is important to do these things in real time. And I think when you break down this kind of scenario, there are two separate things here. One is just the management of the ownership of IP as between the business and third parties, including employees. So it's that basic discipline of getting your work assignments, the right IP ownership clauses so that you get a clear chain of title. And then the second thing is something that often happens in businesses, especially if they are growing fast, which is obviously the focus is going to be on sales and recurring revenue and so on. And people often miss the fact that, well, it's actually important to nail down where the rights sit as between the founder and the different entities within the group. So people do tend to say, well, left pocket, right pocket, what difference does it make? Actually, getting this clear from the start and having that aligned with a clear strategy that presents a clear picture to investors is by far the easiest, cheapest, most robust way to manage things.
Indeed. And again, we go back to, these are fairly straightforward preventive measures that you can take. You just need to know that you need to take them. And I think that's where, the mistakes do happen is, as you said, they're focused on growing the company. Let's get more sales. And in this case here, the company was quite successful. They commercialized rapidly and, they have some fairly eye-popping growth numbers. That just means that software is worth that much more. And right. The longer you wait, And this isn't the first case where I've encountered this. I had another case a long time ago where it was the US entity had developed the software. The UK entity was going to be marketing it in EMEA, right? So now, is there an actual transfer? No. Where the license is going to actually be coming from? Are they US-based licenses for the software, UK-based licenses? In that case, of course, we were dealing with folks that had done this before, knew what needed to be done, and we sat down with our experts in the beginning and said, okay, before we even form this UK entity, what kind of a situation are we getting ourselves into, transfer pricing wise, IP wise, sales contract wise? All of those need to be really addressed, I said, before the entity formation takes place. In my mind, you should be having these discussions as part of your planning meetings, not as part of the ex post facto execution meetings.
Absolutely. Cool. So if we move on, and really by way of recap, what are investors looking for when they approach SaaS Group for the first time?
Well, number one, we've been hammering this one. So if it's not pretty clear, they want to see clear title to the IP. It needs to be. But right behind that is they're looking for tax landmines, right? They're looking for, okay, did you do your transfer pricing correctly? So that's why that transfer pricing agreement becomes so important. If the IP has to be transferred or should have been transferred, and now we have to transfer it, if there's a tax impact, they're not going to pay for it. But the other thing is that investors don't like seeing their money that they put into your company go to taking care of past mistakes. They want the money that they're putting into your company going into future growth, into product development, into revenue expansion. They don't like putting their money in to say, oh, yeah, you have to take care of this $1 million corporate tax liability that's got to be addressed. That will put them off. And even, in many cases, we'll just say, hey, we're not going to do a deal with you. And they're smart enough to look for those things. In the United States, they look for sales tax liabilities now because a lot of companies are ignorant of the fact that they should be paying sales tax into states where they have significant sales, even if they don't have employees there. That's something unique to the United States. We have 50 different sovereign states here, and they all have their own sales tax rules. And it's really quite a nightmare. And then, there's state level stuff, right? We haven't even talked about that. We've been talking at the federal level. In the United States, you also have to deal with tax implications at the state level. If you're in New York, you're going to pay a lot of taxes. In Delaware, you're not going to pay any. It's like, where is your headquarter actually going to be based? So this again comes back to that whole tax landmine topic. IP is one of them, but there are some others that are also present there for any SaaS company that's doing business in the United States.
Yeah, absolutely. And I think it's fair to say that the awareness amongst not just investors, but also buyers, general community, the awareness of transfer pricing risks, so the risks inherent in cross-border transactions, is much higher now than it was 5 years ago, 10 years ago. And that's reflected in things like the growth of the insurance market for transfer pricing risks. So whereas that kind of insurance policy was probably a rarity 5 years ago, now there's a very well developed market for it, which just shows how much people are factoring in transfer pricing risks in due diligence, whereas before it may have been a bit of an afterthought. So I'd just like to do a bit of a deeper dive in terms of what does it mean to get clear on your transfer pricing structure and your intercompany transactions. And so for those who are not so familiar with transfer pricing, transfer pricing is basically the international set of rules, although it's very much fragmented, but the international set of rules which governs where tax is paid or where profits or tax is payable on profits. And at the core of transfer pricing is what's called the arm's length principle, which is that transactions between related parties need to be priced on arm's length terms. And in order to do that, what is essential is to actually break down what are the different transactions between the relevant associated entities at any given point in time. So in terms of the case study that you are going through, Anthony, one of the transaction types was R&D services. So the provision of R&D services initially for the benefit of the Canadian entity and then for the benefit of the US entity. So in order to have a clear corporate structure and a clear basis to apply transfer pricing methodologies, the starting point is to break down the intercompany transactions along the lines set out in this table. In other words, break down the different categories of transaction, whether it's provision of management services, license of rights in intellectual property, appointment of limited risk resellers, and actually get clear on who are the parties to those transactions and what is the pricing methodology. And so this transaction matrix is in effect the reference point for both the legal implementation of the intercompany transactions and also the transfer pricing analysis and pricing of those transactions. Because ultimately, what we're aiming for is a set of intercompany transactions that are clearly described, clearly understood. Each of them are commercially rational, so they are rational from the perspective of each end of the transaction, and then they can be implemented, finalized as regards the price setting policies. And just to add, in terms of what should you be looking for, or what level is required nowadays in terms of the form and content of intercompany agreements, because those agreements are absolutely needed. Well, number one, obviously, it needs to be aligned with the legal fact pattern and the way that the group actually works. In other words, which entities hold which IP. It needs to be aligned with the transfer pricing policies and the transfer pricing analysis, because otherwise a mismatch between maybe transferring reports and the actual legal agreements creates totally unnecessary exposure to fines, disputes, and so on. The agreements need to meet the needs of the wider stakeholders, and we'll come on a little bit later as to who the wider stakeholders within the group are. The agreements need to be clear and unambiguous. So one of the false perceptions in the past was, well, if you keep the agreements vague, they will never be wrong and you'll never need to update them. Unfortunately, the standard which applies pretty much globally is that agreements need to be clear and unambiguous. In other words, they need to reflect and embody a commercial transaction that makes sense and that you, acting on behalf of each of the respective entities, would be happy to sign. Obviously, the agreements need to be signed and dated. We come across this time and time again, that people do half the work but don't quite get it across the finish line. So unfortunately, agreements need to be actually signed and dated. They need to be contemporaneous as much as possible, which means that they need to be signed in advance. Fraudulent attempts at backdating are obviously not going to help anyone. And I guess to add to that list, I would say you're trying to achieve the right balance in terms of the granularity of the agreements, because on the one hand, yes, the agreements need to be commercially rational, they need to be clear and unambiguous. On the other hand, you don't want to make them so specific, so prescriptive that you need to update them every 3 months or every 6 months just because there's been a change in the composition of the team. So you should think of intercompany agreements as being framework agreements, but as being complete in and of themselves in describing what is the commercial deal between the parties. So that's what you should be thinking of when you're sanity checking your own agreements or when you're looking after the agreements on behalf of some other entity. So I'm going to move on and talk about some of the wider cross-functional benefits of having a clear corporate structure and clear intercompany agreements. And I'm going to run through this relatively briefly, and maybe you can add on your own comments. So number one, clear agreements supports entity level accounting, in other words, statutory accounts for the individual entities. And often having agreements is something that auditors will ask for, and often it will create problems if there's a lack of agreements or a discrepancy between the agreements which are in place and the actual operations of the group. Number two, corporation tax compliance. So in addition to transfer pricing issues, many countries operate a position where they will routinely deny a corporation tax deduction unless it's in accordance with an agreement that actually demonstrates the nature of the service provided, for example. So that was the essence of the Aspro case in the US, for example. And there are a number of different countries, such as Mexico, Germany, Austria, and so on, which apply a strict approach in terms of requiring signed and dated intercompany agreements. Number three, transfer pricing, we've already talked about. So intercompany agreements are really the starting point. They're the building block for commercial rationality because they express what is the deal between the entities. And so what is required is something that delineates the terms of the transaction, so explains what is the commerciality and aligns with the requirements of the OECD transfer pricing guidelines and obviously the transfer pricing policies for the group involved. Moving on, regulatory compliance. So this is particularly important for groups which are regulated, for example, fintech companies, because where you have an entity in the group which is specifically regulated, then services, for example, which are received by that regulated entity, even though it's from a related party, it's probably going to be regarded as a material outsourcing from the perspective of the local regulator. And therefore, that local regulator is going to expect to see the same kind of contractual protections as would be obtained or required from third parties. Even aside from specifically regulated industries, the terms of the agreements and the fact that you do have intercompany agreements is a key tool for reducing personal liability risks for directors. So again, it's very easy and natural to look at a group of companies as a whole and manage it as a business as a whole, which is an important filter. However, it's always important to remember that there are individual legal entities having their own boards of director or individual directors, and those directors are personally responsible, personally liable for safeguarding the interests of that entity and of its employees and creditors. So being clear on the terms of intercompany transactions is a key tool to keep those directors safe. Point number 5, tariffs, withholding taxes, and VAT, and I guess other sales taxes. We came across a nightmare situation in terms of a client that we're starting to work with this week, which is a SaaS group, US headquartered, operates a centralized model for contracting. In other words, all customers globally are signed up with the US entity. However, they have a major customer in India. They have a local sales affiliate in India. And the issue is that the Indian tax authorities are claiming that the company should have deducted withholding tax in relation to the subscription fees paid by the Indian clients to the US entity. And so being clear on your contracting structure and stress testing that in advance from the perspective of transfer pricing, ring fencing liabilities, withholding taxes, IP rights, and so on is absolutely critical in terms of avoiding these kind of surprises. And then I guess we've got the overarching filter of investor readiness and exit readiness. In other words, having a clear group structure, in particular, having a clear picture as regards where IP sits and how it is enforceable is absolutely critical and avoids unnecessary due diligence risks and price chips.
I think to lean in on a couple of topics here that Paul so nicely summarized is, there are some founders and CEOs, and this is where, me and my team unfortunately make a lot of money, who feel that the G&A functions, accounting, things like that, HR policies, things like that, those can wait. I need to get my investor cash in and I need to get my ARR up as fast as possible, and I'll let these details take care of themselves later. In my opinion, that's a mistake. These are not, I can get to it later type of things. These are essential. They will come back to haunt you and bite you later. There's no need for you to ignore them because, again, you can take care of these things early. And I'm talking specifically about entity level accounting and making sure that, if you're going to spin off a subsidiary, that they have separate set of books. Believe it or not everybody does that. They just kind of blend everything into one set of books. No, you need to have 2 separate general ledgers, 2 separate entities to keep the books. And you need to make sure that those intercompany accounts are reconciled every month so that the account due on one side, is the exact same number as the account from, the due from and the due tos equal off and are opposite to each other across the entities, especially if you introduce a third one. The other one, of course, is if you're going to put startup money from your parent corporation, the top co, down into the subsidiary, this goes back to not just the accounting for it, but the treatment of it. You're going to put $250,000 or $500,000 into your startup. Is that a loan? Is it an equity participation? Is it, an advance? Is it a receivable? What is it, right? And that's where it goes back to making sure that you have the experts in the room before you do these things and take those steps. Of course, topic number 2 is there are 2 things that you can be absolutely certain of in life, and that's you're going to die and you're going to pay taxes. So you might as well make sure that you are tax compliant from the beginning, and especially if you're in the United States, that includes your state, local, as well as your federal taxes. Don't skimp on those things. We are dealing with a nightmare right now where we had a company that went ahead and started paying payroll to people without registering in the various states that they needed to register in, and they never filed income tax in those states that they should have. And it's, it's a cluster. And again, it's work for us, but it's not the kind of work we enjoy doing. I don't like cleaning up messes. I like building things and systems for people going forward. We will clean up the messes, but why pay for something like that? It's totally non-value added. And then, of course, number 6 is a big one for me. One of the first things we end up doing when we come into an account is get their virtual data room, the VDR, set up from day one, because that uncovers a lot of problems right there. When I say, okay, I want to see all of your employment agreements, I want to see all your vendor contracts, I want to see all your sales contracts, I know that investors are going to be asking for those things. I want to see your incorporation documents, I want to see your cap table. All of that is going to tell me whether or not we have gaps. That's how, that one client, the one that we had as case study, the first thing I said was, show me your employment agreements. And I'm looking through them and it's like, there's no IP work assignment. Oops. Protections for confidentiality, protections for non-solicitation of clients and non-solicitation of employees once you leave the company, kind of basic stuff like that, that protect you as a corporation. That I, as a CFO, am looking for when I come into a client for the first time is making sure that there aren't any what I call extinction level events or landmines that somebody's going to end up stepping on because these 2 things in particular were not taken care of. So getting your virtual data room set up from the beginning is a fairly easy thing to do, and it also is a really good discipline for you because it makes sure that you have everything in line. Trying to put these together ad hoc afterwards when all of a sudden, oh yeah, we bootstrapped this thing, now we need to bring in some investment capital. Who has the employment agreements? Oh, I don't know, Joe has them. Really, Joe? I don't have them. Maybe Mary has them. That kind of silliness, Paul's laughing. That kind of silliness is like, it's just a total waste of everybody's time. It's like, look, you can set these things up. And it's not hard to do. Go out and get your favorite AI, Perplexity or Chat GPT, and say, oh, how do I set up a data room? It'll tell you. And tell you what you need to have in it. Again, it's not rocket science. So, I would just say from, the nuts and bolts perspective, there's a lot of stuff that you can do in the beginning that's pretty easy and pretty low cost that if you don't do it is going to be not so easy and it's not going to be so cheap later to fix.
Yeah, I love that. I think, in a way, the VDD setting that up right now is the key to everything because, as you said, Anthony, it just flushes everything out and it gives you the runway to sort out the errors in private as opposed to in public, which is going to be a lot less embarrassing and a lot less costly. Key actions for founders, CFOs, and general counsel: go with your vendor due diligence, get your virtual due diligence room in place. But I wanted to go through some of the points on this slide because I think it's really important. So number 1, check your IP assets, IP strategy, and chain of title. Does it reflect the reality and is it clean? Just one misconception here, which includes in relation to SaaS groups. You may think that, well, what is your IP? Is it the code, the software plus the brand? That may only be part of it, because it may well be that actually you have developed a huge amount of process type IP or know-how that is actually one of the major differentiating factors and is actually the key to the ability of your group to continue to make money and to scale. So make sure that you're thinking from the broadest possible perspective when you're doing your audit of what intangible assets, what IP do we have that we care about and that we need to get clear on how we're protecting it and where it sits. So I'd really want to emphasize that point. Number 2, identify the key stakeholders for intercompany transaction design. So that means before you do anything, before you set up your local entity, before you finalize your intercompany agreements, before you finalize your transfer pricing analysis, make sure that you've got the right people in the room metaphorically. So that includes the disciplines of statutory accounting, transfer pricing, withholding taxes, sales taxes, and so on. So it's only by taking a global, holistic perspective that you can get comfort that the structure that you're going to execute on is actually the right one for you. Next step is to go through that exercise of creating a clear matrix of your intercompany transactions, taking into account your contracting model, the legal ownership of intangibles, and how you want your group to be designed. And that may mean that actually you're looking at two things. One is understanding your current position, so your current contracting model, and it may be a look forward position. So you may need to migrate to a future state. So just like Anthony's example of changing from Canada to US, because that might involve, number one, getting clear on your current state, and number two, designing your future state, and number three, designing how you're going to transition from A to B. And that may sound like a lot of work, but as we've been mentioning a lot of times, it's far easier, simpler, and cheaper to do that now rather than to try and retrofit and clear up the mess after the event. So obviously implement the matrix through clear intercompany agreements which reflect the TP analysis, which reflects the contracting model, which reflects the IP ownership model that you want. And then assign responsibility for regular review and maintenance of your intercompany transactions, because this is not a one-shot exercise. It's, in a sense, maintaining your virtual data room on a year-by-year basis, because from a tax audit perspective, yes, we're in 2025 right now, so we need to document company transactions in 2025, but the due diligence or the tax audit may not happen until 4 or 5 years down the line. So you need to make sure that on a year-by-year basis, you're keeping your key documents in the right place so that you can respond confidently when the questions arise, notwithstanding that people in your team may have changed. So, Anthony, really interesting to hear your perspective. So when you start working for a new group, what would be in your 90-day action plan?
The 98-day action plan for us is very straightforward. To your point, we start with the data room.
Right. Yeah.
That alongside of reconstructing the financial statements, usually because dealing with SaaS is a very specific set of financial statements, the way that the industry expects them to be laid out, both from a balance sheet perspective, especially on the P&L basis. And in doing so, I like to use the analogy of your accounting system is basically like your spinal column in your body. It's the thing that everything else hangs off of. And if you've ever done yoga or a martial art, you understand that having a strong core is absolutely essential to your health and well-being and your strength. Yeah, the same thing applies here. And I'm not mincing words. I actually have a medical background. I've actually taught yoga and I also do martial arts. And I can tell you that having a strong core is absolutely essential, and it works in corporate finance just as well. Making sure that those financial statements are correct is pretty much the first thing that we do. And we uncover a lot, right? We uncover a whole bunch of stuff by going through there and cleaning those up because, to your point, oh, gee, where are all these payments to this Canadian corporation? What are those? All right, what's all this invoicing coming from the India corporation? What's all that all about, right? It'd be really basic stuff like that, and then you start pulling on the threads. So, really it's two things that get started in the beginning, which is re-engineering the financial statements. That uncovers a tremendous amount of, we'll just say, buried bodies right there, if there are any. It also is really illuminating because most of the times people who set up their financial statements, they don't know what their gross margin is. They don't know what their recurring revenue actually is. They don't know what there's a whole bunch of stuff that gets illuminated to the executive team. And if there are already present investors that are like, oh, we didn't know that. And then, like I said, that data room. Start off with all of the contracts, every contract you can get your hand on, and read them, because that will tell you, especially if you're a knowledgeable CFO experience, if you have any holes. Once those two are really addressed, we move on to the financial forecast, the cash forecast, the KPIs, the things that the executive team is going to need, equity plans, equity compensation, all the other interesting stuff that goes on after that. But it really starts with the very fundamental basics, which is getting the core straightened out and strengthened. Yep. And that's your financial system, your general ledger, as we call it, the accounting system, pick your term, and that data room, making sure that we have all of this information. and that there are no landmines. And if we find them, we know how to defuse them and get them taken care of. As you said, air the dirty laundry inside, not when you're about to go to an investor and you find out, oh, gee, we never really filed a subscription agreement for our stock. If you don't know what that is, you should ask me.
Perfect. Thank you. Well, I'm going to open up in case people have questions, just to get things started. Anthony, in terms of what would you say is the biggest misconception that people have when it comes to corporate structures and group structures for SaaS groups? What's the thing that people say over and over to you that you say, no, that's just not right?
It really comes down to, okay, I am the person who owns all this stuff, so it's all mine anyway.
Right. Yeah.
Right. That's not true. I mean, yes, technically, maybe it is true, but in reality, you have to have these entities set up in ways that make corporate ownership strength or sense, also make tax sense, make all of this in various senses that you need. Just because you are the single owner and you have control of 3 entities in 3 countries doesn't mean that you actually, that it's clean, right? So that, I would say, that's the biggest takeaway, is that the owner who thinks that, well, I own it all, so it doesn't really matter. Yeah, it does.
Yeah, and I'd say that there's a corporate equivalent of that. And actually, we just came across this week. So it was a US-owned group. It's actually about $500 million of revenue. They'd acquired a set of entities, and they had attempted to do an integration of those entities by hiving up the trade and assets into one of the existing entities, and they did it for nil consideration. So they said, well, this is all intra-group, and this is just in the nature of an intra-group rationalization, and therefore we don't need to pay any amounts in relation to those hive ups. And it's just astonishing how you come across this attitude, well, it's all within the same group, and therefore we don't need to think about the individual terms of individual transactions. No, unfortunately, you do need to think about how each individual transaction plays out from an entity by entity perspective, rather than just saying it's all left pocket, right pocket, it doesn't matter. And what that means for us is similar to your case study, Anthony, which is, unfortunately, we need to unpick that transaction because it's actually, from a legal perspective, we can't backdate it, and it just creates totally unnecessary complexity in terms of the corporation tax position, statutory accounts, and so on. So I guess we've already done the summary and takeaways in terms of clean title to IP being absolutely foundational, and what you've described, Anthony, as the backbone or the core in terms of the accounting system and virtual data room. So starting on that, I'm actually going to move ahead and we will wrap up unless anyone has any specific questions that they'd like to address. So, Anthony, you've given a brief update on, or vision as to how you start to work with groups, but maybe you can give us the rundown of how you help groups when you first start to work with them.
I mean, mostly what we do is provide illumination, is how I look at it. Is things were opaque to the owners. We don't understand where our burn is, or we're not clear on our cash forecast, or we don't know what our gross margins. We have no idea what our SaaS metrics are. They need somebody to come in and help them get those things in order. That's probably our number one bread and butter client, is somebody who is up and running. They've gotten some VC money, or maybe they've bootstrapped it. They're getting to the point now where they've paid some attention to the back office, but they really need somebody to come in and say, here's how SaaS is done. As I like to tell my team, our clients pay us to execute, not experiment. We come in and tell you this is the way it's done, because we've been doing it for decades. So really, that's what it is. If you want to talk the SaaS talk and walk the SaaS walk with investors, with potential acquirers, you need to have all the numbers and know that those numbers are correct. The last thing you want to be doing is guessing on your numbers, because I tell you what, some smart due diligence person is going to take apart your numbers, and they're going to find out if they're not done right. And then you lose your credibility, and your deal can go away just as quickly as water into sand, because from the get-go, you didn't establish that you had the correct numbers. And there's also other stuff that goes on along with that, which is, we recently uncovered, we came into a client, they thought they had great retention, then we go in and start actually analyzing their numbers, and we realize that the retention numbers are actually pretty poor. Turns out the problem was in the sales team, and they were selling to anybody who frosted the glass rather than trying to find clients that were ideal. And of course, when you sell to anybody and everybody who's willing to write you a check, you're going to get a lot of churn. So there's operational strategy, there's tactics, there's, the information side of things, there's the numbers. I like to look upon me and my team as a very comprehensive solution. We're not just the numbers guys, to be pigeonholed in that. The CFO needs to understand the company as well as the CEO in many ways, because there isn't a single decision that goes on in your corporation that doesn't have a financial impact. So, understanding how all that works, how to optimize it, save cash, those are our clients, and that's why they stay with us for years and years.
And my understanding is, from an accounting perspective, from a financial metrics perspective, subscription model businesses, SaaS groups, they actually use very different metrics compared to other categories of business. Is that correct?
They have specialty ones. Right now, everybody has cost to acquire a customer. If you don't know that, whether you're a manufacturing company, a service provider, or a software company, how you actually calculate these numbers is a little bit different. But SaaS has its unique things, the net retention, net revenue retention, the gross retention, the ARR growth rates, especially gross margin. Everybody in any business should be focused on their gross margin. I came from a manufacturing background in the beginning. Believe me, you need to focus on that gross margin. It doesn't matter what industry you're in, but how you define that gross margin, that is very industry specific. SaaS has a way that it wants it defined. And if you don't define it that way, again, you're going to run into credibility issues with anybody who's evaluating you. And you can't benchmark yourself if you're not calculating it correctly, so you don't know how you're performing versus the industry. So yes, the short answer is absolutely. There's a SaaS way of doing things, and there's a non-SaaS way of doing things. If you're in SaaS, you want to do them the right way.
Perfect. Great. And just to explain about us at LCN, we're corporate lawyers. Our USP is that we're corporate lawyers who speak the language of transfer pricing. One of the things that typically happens with groups, including startups and large corporates, is that the exercise of designing cross-border transactions, intercompany transactions, and then analyzing them from a transfer pricing perspective and actually implementing them legally gets dropped in the middle somewhere, because the tax advisor, the tax function says, hey, we don't do legal agreements. Even though the group may have extremely capable in-house lawyers, they're probably not familiar with transfer pricing and the specific requirements for that. And it's that disconnect that we're here to address. Around 50% of our clients right now are headquartered in the US. We take a global perspective in the design of intercompany transactions and intercompany agreements. It's leveraging our experience of working with hundreds of groups and thousands of transfer pricing professionals worldwide. Specifically, what we do is that we come in and give you a legal health check of your corporate structure and your intercompany agreements. We help strengthen and streamline your intercompany agreements. A lot of groups have gaps, defects. A lot of groups have much more complicated, complex portfolios of agreements they actually need. They contradict their transfer pricing policies, so we help clean that up. And number three, we provide ongoing maintenance and support to keep you due diligence ready as regards your corporate structure. So we've pretty much come to the end of time. I'd like to thank everyone on the call for joining. I'd especially like to thank Anthony. Thank you so much for sharing your experience and your case study. And I love your virtual data room. Number one piece of advice, which is start populating that now and use that as the way to flush out your embarrassing secrets and fix them in private.
Thank you, Paul. Been great. Thank you. Really appreciate it.
Thanks, everyone.